Good evening, everyone. I'm Ardres, Junior CFO of IEDC GCB. This year, IEDC GCB has started a new financial community to help the students improve their financial knowledge. As a part of that, we are here with a talk session on the topic financial independence. To handle this event, I invite Ms. Sujitha Rajagopalan, who is the head of operations in Trycle, an e-learning platform. Over to you, ma'am.
Thank you so much, Adra. First of all, good evening to everyone, and congratulations to the IEDC Department of JEC College for your innovation and entrepreneurship development community. I think it's evident enough that the youngsters are taking more interest in being more involved in what exactly is going on with the market or the industries of finance. Moving on to introduce myself, I am Sujitha Rajagopalan. I am the head of operations for Trycle, which, like Adra mentioned, we are a skill enriching platform among graduating students and helping them basically place a job relevant to their academics as well. Previous to this, I was the senior vice president with Goldman Sachs, an investment banking firm here in Bangalore. And my entire tenuity there was for 13 years. Professionally, I was involved from trade reconciliations to client management to risk management, learning and development, and finally client onboardings for the firm. I quit in 2018 and joined Trycle along with the founder Arun Chandran. And ever since there, I've been there, and we've just been managing to run the show as well. So moving on, I have a presentation, so I'm going to open that and let me know if you guys can see it. Is my screen visible for everybody?
Yes.
So let's start, right? Unraveling financial independence. These are some of the common attributes, and some of them are my favorite entrepreneurs or businessmen who have mentioned, according to them, what exactly has been financial independence. But if you see the keywords highlighted over here, it kind of revolves around everything that is a summation of what exactly this talk is going to lead into. We are talking about savings, we're talking about investments, we're talking about our own power to produce wealth in any form, and the skills that is required if you are going to, and it has to be constantly developed. My personal favorite being the second last one, which is my, again, a mentor according to me as I was working in a finance company. Rule number 1, never lose money, and rule number 2, never forget rule number 1. And that was quoted by Warren Buffett as well. So I think to summarize, the attributes of financial independence always comes down to the most powerful element being money. And the structure of it around that is going to be how to save money, how to make the right investments, how do you know how much is enough, or how do you know that how much is not enough. So these are some of the key attributes that I think globally everyone will come into consensus when it is about finance or financial independence altogether. Moving on, after your committee reached out to me and said that the talk on financial independence is something that they would like me to do. I created a small survey among the people I know in the class of, the students who are still working and people who have placed their first jobs. So the age group is around 18 to 25. I think most of us can relate to these pointers. I personally can definitely, when I take myself 10 years back, definitely I can relate to these as well, as to what are those small common reasons that all of us feel that we need to be independent, especially when it comes to handling money, right? And some of them here is limited pocket money. I remember personally when I was growing up, my father would make me do these small tasks in the house, and he would pay me small amounts for that. So filing his tax returns, I would get about 15 rupees, or cleaning my room. Of course, I didn't have to, but he would make me clean my room and tell that, okay, there is a 50 rupees attached to that as well. So limited pocket money is something that we all start with when it comes to handling money. And some of us are unable to convince our family also with regards to getting some kind of a pocket money. And say, most of us, if you have any side jobs that you do, babysitting for your family members or cousin sisters or neighbors, or excuse me, I have a bad cold as well, or running any kind of small errands in the family. We try to, I think at a young age, we have all those options as well to make some gains out of the kind of lifestyle that we want to do. Whether it is getting a job, and then again came a point where salaries were not for me. It was always dependent on the expenditure of the necessities around me. And obviously, I think most of us have our parents controlling our money as well. Then again, when you move on to the, say, second year of your working time, you will start having social responsibilities, the entire socio-economic system of family or marriage and children, all that keeps growing upon you to start thinking that, okay, this is where all my money is going to go. This is where all the budgeting happens. And I always tell this to most of the teenagers around, that the best example for budgeting is actually our mothers, because they will be aware that, rice is over or wheat is over or oil is over. They're aware of that, but they are not able to manage the financial part of it after that, right? So I think all of us grow with that experience, but then how do we get to do it the right way? And that the next slide should give some insight into, right? Before we go into, yes, how are we going to do this? What are the best ways of doing this? Do we have a proper pipeline and plan? Let's talk about the different levels of, getting to financial independence. And again, most of us should be able to relate to this, because you guys are young and bright and you're still getting into that transition of making your own choices and handling your own money, and thinking about ways of investing and the kind of strategies and the kind of products and instruments that are there in the market. All of us, including me, our parents, all of us started with financial dependencies, where this is pretty much us as children, where we have to depend completely on parental control, because the basics are being provided from there. So financial dependencies is where we are all looking to become free from those kind of debts, but technically we don't have those debts because somebody else is spending for us, right? So that is the first stage of when it starts in each one of our lives. Going on to financial solvency, this again comes, I think, at a time frame of our teenage till when we are going to finish our higher primary educations, where we are able to get to manage or balance out the small debt and the small income. That is the pocket monies that we might be getting. We are able to maybe save them up and buy something that again comes with a blanket budget, right? So if I need to buy a good pen, then I think I have to save up for at least 4 weeks and then be able to buy that. But I'm able to keep that saluted into the time frame of my before I pass out my higher secondary. Third is when your financial stability, and most of you are transitioning through that path where you'll finish your educations, you'll come into the most crucial aspect of making a choice of your career growths and developments, having that first job, the salary that it pays. But yes, once you get that salary, I guess that flexibility of clearing your debts, although you will have those debts, whether it's going to be credit-based, whether it's going to be your EMI saving up, or it's going to come from a space of your student loan clearing everything. So it gives a flexibility that you're able to slowly start clearing these debts. And that again is a transition period of right after you graduate and get into your jobs. The fourth one, and this is one of my favorites, and I think recently is when even maybe I would have come up that curve, is your posting financial freedom. And here is where, again, Warren Buffett has quoted that don't put all your eggs in one bucket, right? So there is something known as the 25% rule in investments, where 25, 25, 25, 25 makes the whole 100, right? So you have to make sure that your investments and these are diversified, right? So you can start from your pharmaceuticals maybe, you can go into your infrastructure and technology. You can choose any kind of portfolios or investment strategies, but make sure that, if you apply 25% in all these 4 buckets, eventually this is going to lead to a space where you will come to think about, if I've done that enough, I can always take a step back from a job that I don't like, and the happiness quotient can work in this exact level. So people can decide to quit their jobs, which is they're not happy about, and they are looking for a happiness quotient, and they're ready to take a lower cut as well, if this 25% has been applied clearly in their financial plannings. Post which you come into financial security and flexibility. Now, for me personally, this is a very, oxymoron level to be at, but it makes sense because all your investments that you're making or you have made during your financial stability times, right? It should ultimately in your plan pay off and not touch the income that you're actually making. Now that investment is varied. It can be from your commodity investments, it can be from your stock investments, it can come from rental property investments, it can come from anything that you have already planned in the 25% in your costing financial freedom bucket. Moving on to financial independence, which is the highlight of today's talk. And like the 25% rule of investments, there is a 4% rule. And personally, I believe in that because I think the Trinity School of Study is the one that came up. And this is, again, assuming that you have assessed your entire financial growth plan and you've timed your goals and you have understood, you have made sure that your expenses are decreased and your income has come to an increased point where at the end of the year, you are able to say, take out 4% from the total wealth that you have accumulated and still not feel the pinch, right? Because this 4% is going to recycle and turn over into the next year's, say, annual income. So if you have 1,000 rupees, you are able to take out that 40 and still not feel the pinch. That is where most of them are able to plan this for, say, a 30-year-old retirement plan. I will work for 30 years or 35 years, and then I get into a retirement. I'm able to make that plan today itself, keeping in mind few market factors as well. One being your inflation rates, which is nothing but understanding and learning how this market is going to function in the next couple of years as well. As we move forward, as we progress with the slides, I will explain that more in detail. And the second thing, I think, again, all of us should definitely start being invested in is a passive income, right? Passive income, in simple words, is something that you're not working for, but will start making an income for you. It will start generating a wealth for you. These are the two things now we're going to talk about in our coming up slides. And these are the two things, personally, I would suggest this group to be vested with as well. Again, because youngsters today making those choices about money is a very, very good thing, and it's very crucial as well for today's, socio-economic growth as well. Moving on, how to do it, right? FIRE is financially independent, retired early. That's the abbreviation for it. And how to seek that is more to understand that, again, all of you sitting down, mentioning down your goals, right? Having timelines is crucial. And what I mean by timelines is not just adding an age number to it, but making sure you add the years of investment that you can plan as well for yourself, and the different types of investments that you can make and you can actually be on top of, well read about, whether you're talking about being someone who likes to do day trading versus intraday trading, or someone who actually just likes to say that, hey, I invest in a diversified portfolio and I just want to see how the returns work once in 3 months or once every month. Making sure that that is what you're seeking from your financial investments, very, very important. And the first step is the one that takes the most time, actually, because once you have the blueprint ready with regards to what is it in that, what is instrumental in that momentum, I think is very, very key. Second thing, assessing your current financial situation. This is completely your net worth, And what all comes under net worth is your assets, whatever your liabilities could be, and what is the current income that you're running with. So your income minus expense, very, very important, because you have your assets and you have your liabilities. So you have to match that to what exactly is your current situation and what is the difference that is going to fall in place. That will be your net worth. And that should be the point from where each one of us should actually think about investments or think about expanding our wealth cycles, right? Increasing your income. Now, this comes to a point where you're working somewhere 2 years. If you're going to look for, hey, in the next 3 years, I have another percentage goal. Can I get a higher paying job? Now, quitting my job and looking for it, no, you're still going to stay in the financial solvency state because you're just balancing your debt and your income, making sure that you're able to do something in the side. Now, that is passive income. Freelancing as you're having your job, or investing as you're having your job, or making stock bond relationships, or investing in bonds or treasury notes from the government, renting out property. So many various ways of actually creating that passive income as you are having a steady income as well, right? Now, minimizing your expenses. I never call it decreasing because, again, we are humans. At the end of the day, each one of us, if we are working so hard, we have to enjoy some of the spoils of lives as well. So for me, this point is more of, minimizing our expenses. And again, timeline is very, very key. Using a Google spreadsheet to start jotting down the budget plans that you have, understanding a budget plan, and what are your expense targets at the end of the day. Where are those places where you can crunch a number, but the crunch numbers, say investment, can be reinvested in a different place. So trying to minimize your expenses is key as well. And this, again, after the first, I think this is the one that takes the most time for all of us as well. Right. And the last point, like I mentioned, creating a passive income. Now, this, bear in mind, this is income minus your expenses. That is your net worth. So anything that you can earn without actually working on that, usually, again, most of us can correlate to is renting out our properties, which I think from historical times, most of our parents and the family system has actually taught us that as well. And today's generations are okay to go forward and expand it into investment as well. And we have multiple instruments that kind of speak that investments are a good way of looking to earn that extra income, look to grow into that, the whole graph for us can go upwards. But obviously, investments come with its own highlighted risks as well. And the next slide is going to touch more on the methods of how we can do this, whether it's the old conservative style or the not so conservative modern ways. All right. Now, having clarity, yes, for all our money leads to better understanding and making better choices. Again, this goes back to my first slide. One of the key attributes of having financial independence is us having those kind of choices that we can make. Now, some of the conservative ways that most of you would be listening to is, I think the best example is mutual funds, right? So some people are okay to take a mutual fund. Some people want to know that, is the return going to be risky? Is the investment in itself going to be risky? And how that product in itself has diversified today. So first thing about the conservative way, and this again, I remember because my mom is somebody who always believed that you need to save up for the winter. So building a reserve that you can access anytime during an emergencies. So usually these are in the forms of your savings accounts or your fixed deposits that have a maturity rate of 3 years. Then, of course, long-term investment plans with high-yielding savings account. Now, long-term investment plans always come with, moderate risk attached to them, right? So these are products where you have to keep it for that much time, and it always has a bracket of inflation rates attached to it. So it's a very conservative way. I think previously it used to be where you can go into the post office and take a TDS, time deposit, or a national savings certificate. So Those were some of the methods previously that were considered conservative enough for nothing but the fact that they are very minimalistic in risk. They have associated risk, but it's very minimalistic when it comes to the conservative way. Third point being keeping a solid budget that you have for every month of your life. And personally, again, this has helped me also, because when I was planning for whether right after college I want to go for a higher education, whether I want to leave the country and take a break or something, this kind of really helped me, because ultimately this is coming back to what exactly is my net worth without a passive income. So ensuring that whatever was coming my way, are they reinvestable? Even if they are reinvestable, after investing, can I have something with me for the end of the month? That kind of helped me as well structure it for myself, and that kind of became an eventually now after 10-15 years, it's become something that I'm constantly doing, just autopilot mode now. And the last is the instruments that's out there. So from an investment side of investment way, method of living, right? You have so many products today from, I think, I'm sure Bitcoins, cryptocurrency is something that you guys definitely would have at least heard about and have been, excited or anticipated to know more about, because the returns that it has shown is insane. But some of the products from a very conservative method, and again, these are something that, the second generation will definitely be able to correlate, is government bonds, commercial papers, saving accounts, your dividend stocks, again, investing in something that will give back a dividend at the end of the day, or holding insurances, cash, capital market, money markets, recurring deposits. These are just products of importance that everyone at one stage have always thought that is the best way to invest in, and only because, again, they're trying to minimize the high yielding risk component attached to that, right? Now coming to the not so conservative way, and this is pretty much from the early 90s or the 95s or so, is you have a reserve and you look to reinvest that every time. So there is a steady income that you're going to make. It could be from the very basics. You pull out maybe a 5% from that and you reinvest that as your reserve, and you're ready to take that risk every time. That is when the market introduced products like mutual funds. They're able to introduce products like Forex trading. They're able to introduce products like swap tradings. So that is where you're going to keep reinvesting. It's more like, it's taking part in an arbitrage in the market, right? You're able to reinvest that money in those instruments as well. Short-term investing. Short-term investing obviously comes from, I invest this for a very short term. It could be an overnight sweep. I am investing on the interest of that sweep only. So again, the only risk attached to that is that that interest can be at a lower inflation tomorrow, and it can go at the higher inflation. Before investing in something of those kind of products, just a cautious suggestion is that make sure you understand the life cycle of those kind of products, whether it is in any market. But I think, again, in Indian market, you have to understand that this is how the life cycle of this product is functioning. When exactly is the payout? When is the yield rate going to be explained? When is the interest rates going to pay out? What is the principal amount that you might have to pay? Those are all, again, parts of the instruments that is very important for especially young investors to be aware of themselves as well. Or, of course, if you think that you have it in you and you have someone who's a very strong financial advisor flying with you as well, then yes, sit down and think about those kind of high yielding, higher risk instruments in the market today. And then returns, of course, always understanding that any return on your product in a fluctuating, volatile market is always dependent on its performance as well. So again, understanding whether you want to do an exchange traded investment, or you want to do something that is completely an IPO relevant investment, or you want to buy more equity of a company, you want to understand how these returns have maybe performed in the past, or how what are the analysts telling that they will be performing in the future as well. So understanding that, especially again in Indian market, whether it's following Nifty or the Sensex aspects of it, taking a clear picture, and this goes back to my previous slide, right? understanding the goal of exactly where your investment should flourish is very, very important, and it's key. And the kind of products of importance in the not so conservative way, we've all heard this in on our televisions: mutual funds, ULIPs, unilinked products, real estate, very good. And again, this is a moderate to high risk product consumptions, right? So it's more of it's a bigger scale at the end of the day. So, but again, I'm sure some of you would be really smart with that as well. Hedge funds, extremely important to understand the life cycle of each single product that comes under a hedge fund. Forex trading, very crucial to know that they are directly linked to the inflation rate of any economy. So keeping an eye of the kind of pricing that Forex trading is going to go through is also key. But again, there is high return in these products. When I say high return, they are almost double of what exactly your product of importance in your conservative way can be producing for you. Moving on. Some of the things that we can keep in mind and can make sure that it is not rocket science. We just have to make sure that these are those steps involved, and I guess getting each step at least right, and maybe not accurately right, but getting it right is very important for, again, young adults who are going through this transition period of finishing your education, looking for that career option, or looking for a higher education as well to go out of the country, pulling away from the dependencies of our guardians and our parents when it comes to money management. Yeah. Some of the key factors, and this is completely direct to how to do it. Your net worth. For your net worth, the 5 main elements that you have to keep in mind and have to reiterate and understand. First thing, assets. Everything that you own, basically. Again, you may not own everything that on paper or anything, but if your accounts are there, if you have your savings account, if you have a house or you have a property that definitely can be refurbished for something, for a passive income, etc. Very important for you to make sure you have this, draw the net value from that. Liabilities, everything that you owe. Now, this can come from the space of you already are working towards as well, because you'll have your credits, you'll have your student loans, you will have your EMIs, you will have your premiums and everything. Those are your liabilities. I always have an argument with regards to whether car is actually an asset or a liability. According to me, yes, it is an asset, but it is a depreciating asset at the end of the day, because you will never quote the same value when even after 10 days if you want to sell it back. So you can always add it under an asset itself, but there is a depreciating value to it. Third thing, your net worth. Like I mentioned, this is all what your assets is going to return back as a net investment, and the cash flows that's going to pay off from that. That is going to be your net worth, minusing all the liabilities that you have. For instance, if you have a room that you rent out, it has to pay off your EMI. If it's going to pay off, say, 10% of your EMI, the remaining is what your net worth is going to be. You pull off that much amount, or all your expenses, all your social expenses, whether you have Netflix subscriptions or Hotstar subscriptions, remove all that, and then is when your entire asset net worth is going to come into picture. Income. This is something that is very steady. You have to make sure that anything that is coming in, if you have a salaried job, throughout the year, you can know that there could be a performance bonus attached to it. There could be something like you can get stocks from the company as well. So all this is something that is going to be part of your income, your pensions, your PPFs, your rent on the property, your interest on your bank accounts, your dividends from your stock holdings. All this is something that is going to inflow to yourself as well, forming your income bucket. Expenses. This again, like I mentioned, it is part of something that is going to be where you're paying out. This is a liability as well, making sure that in that budget, these are the 5 most crucial elements of a person's net worth that has to be calculated for you to make sure that how much of that remaining I can go ahead and invest. Now, remaining investment is where you're talking about that 25%. Each of that bucket that you choose should have 25% of that exact net income that you pull after all this calculation is done. Yeah. And finally, something that is important, and this is something you can all keep at the back of your heads, something that you can on a daily basis maybe spend 15 to 20 minutes. And this is something I also tell the women who we are working to empower towards, is that this is very, very key for women also to pick up, especially when it comes to money management, because it's important that we also understand that these are the things that is involved, and it's no rocket science at the end of the day. So personally, again, to me, these are the three important components that can, summarize how much of your financial planning is with your hands. Right, understanding your investment rate of return, extremely crucial in today's investment cycles as well, where nothing but what is the average return that you can expect on a monthly basis or yearly basis or half yearly basis on the investment that you're going to make. Even if it is the 10 rupees or the 500 rupees that you're going to invest, it has to be where the inflation of 2 to 3%, it has to be above that. So even if it is 2.53% a return that you're going to get, you should be aware of that for sure on that instrument, on that product, on that commodity, whatever it is. So very simple is say gold, right? Gold is something that as a commodity, you understand goes through an inflation and fluctuation, and there is a market that takes it through as well. Petrol, oil, we've all heard about it. So these are commodities that we know on a daily basis we consume. How does that work on them? How does the investment rate on those work as well? To begin with is the only tip I'm giving. So you can always start picking it up from there. The second aspect is inflation rate in itself. This is how, again, because the market decides the currency movement. The market decides whether the currency has to dip today or increase tomorrow. 2% to 3% usually is what it is today. I think our inflation rate stands at a 6%. That is the currency value at the end of the day. So you need to make sure that you understand how it has functioned in the past, how it is doing currently, and will this change in the near future or not, or how much of the change is going to come through. Am I able to take that dip so that if I have a diverse portfolio investment, it's okay that is going to do well for me. So say, for instance, you have ETFs and gold in your diverse portfolios, right? Tomorrow, if the inflation is going to hit an ETF, it's going to go down, but your gold is going to stay at its value perhaps. So making sure you understand the inflation rate on the instruments that you're investing in, extremely important as well. And understanding how this works and how this has worked for everybody, or for at least some mentors that you might actually have in the investing world. And the last one, SWR, safe withdrawal rates, is coming back to the 4% rule, right? At the end of the day, your investment, the wealth that you have accumulated enough to start making money for you is working. And every time you withdraw to cover your living expenses, especially touching towards retirement, obviously it's high dream that we all want to retire today. Even if we win the lottery, it is something that we will stick to for the next 3 years. We will want to reinvest that money. But understanding how much is that safely withdrawal percentage rate for me, and sticking to that, at least again for a tenuity, keeping a timeline in mind, that should be the goal. And that should be the factor of determining that next year, should I pull in more? Should I increase my investment? Should I increase my wealth? Should I increase my net asset so that I can increase that from a 4% to go up to, 5%, or come down to 3%? So these three important keywords are something that will definitely, I think, help you guys as well, if you spend more time understanding how this really makes a momentum in the market and how people take crucial decisions around them. Yeah. And yeah, I think I'm going to stop with that. Thank you so much. You guys have been a great audience, but I will definitely take questions for the next 10 minutes or so we have now.
Are there any questions that anyone would like to ask?
Hello?
Yes.
Hi.
Hello? Okay, I have a question. Does a higher education or change in my career or industry promise me more financial value?
That's a very good question. Again, by keeping in mind the recent kind of development and the recent kind of people's way of functioning. You do your engineering, and then you understand the kind of job you are into. It expects to have an MBA, and then you do your MBA, and then you expect that, okay, fine, now I'm going to get into a higher paying job because I have the degree of an MBA. Again, that becomes your liability, right? So moving from your academics into a different academics, taking that career change, always ensure that these are the things that you can always think about at the back of your head to know that, is that going to be an asset or a liability for me ultimately? Getting an MBA right after your this is just an example, don't quote me, but getting an MBA right after your engineering is just going to add on to the baggage of your loans to be cleared at the end of the day, or the fact that you still need to build on experiences. So what I would say that as something that I would suggest is that taking a job or doing a proper salary job for a proper tenuity of 2 years or 4 years will enrich you with enough experience, and also the company will give you certain perks as well that you can always build upon and build an investment strategy for yourself. Post which, when you're able to make sure that the liability is going to be decreased, and then you're going to come to a space where, okay, now if I quit my job for the next 1 year, I can be on this flexibility, the financial flexibility we spoke about, then yes, choosing a higher career, choosing a higher degree will definitely, maybe, you won't feel the pinch more then. So at this point, having a career change, much before that, I think you guys should just sit back and understand that, okay, can I work for the next few years? And you can always draw the tenuity for yourself, 2 years, 4 years, 1 year, whatever it is, right? So I hope that has answered your question, Nazreen.
Ma'am, shall I?
Sure, Mohammed, yes.
Yeah, actually, being financial independent, there must be some risk factors, right? What are those? Maybe the risk factors in financial independence.
Again, very important to keep your eyes open with regards to, what are those instruments of investments for me initially that I can take. Now, there is, I'm not wrong, there's a book actually, yeah, it's called Change Your Habits, Change Your Life by Tom Colley. So this very clearly says that financial independence is not just about income, or it's not about the wealth part, right? You need to understand that, what are the kind of instruments that come with what kind of range of risks. So for instance, say your mutual funds. Mutual funds could be a product that has extremely high risk. Now, some of you might actually be able to cope around that and understand that why is it so high in risk, and work towards, adjusting your instruments there. Some of you might not really do that. So you're completely dependent on a third party. So there, the risk of economic efficiency is always there, because it's easy to tell you that, hey, if you invest, say 2,000 every week, at the end of the month, you will be getting like, I don't know, a 15% increase. So, that is something you can question, because 8 to 10% is what even nationalized banks give us today. So making sure that any instrument that you're investing in, understanding the economic efficiency for that is key in any investment, especially among youngsters. So that is one of the very, very important risks that each one of you should be always aware of. And even before investing, talking to, I know most of us go to our family, most of us go to, I think I used to go to my father, and most of us go to somebody who has that kind of expectations, or whom you can derive from. Before that, actually, maybe talk to the people who could have invested in something like that, and who have a say about it. Who you think that, okay, you are actually making a fortune about it. Can you talk through the risks that I should be aware about? Rather than spending the time of understanding how this is going to double my money, always ask your advisors or people around you that, hey, what exactly is the risk associated around this? What have you felt? And break it down. Say that if I need my return to come back within 3 months, how best will it pay me back? Payout. How are the payouts looking? How are the rates looking? How are the interest rates around the product looking? So yes, the economic efficiency of each product is one of the biggest risks that each of you should definitely, be aware of. I hope I answered your question, Mohammed.
Yes, ma'am. Thank you.
Good afternoon, ma'am.
Sure. Malavika, go ahead.
I was wondering if you could enlighten us on the difference between financial independence and financial freedom.
It's a very good question. So that is something that after the 6 levels of financial, dependency, say like a financial independence we talk, the last is your financial freedom. And I keep calling that is the nirvana stage for everybody to be into, right? Now, financial freedom, very simple terms, it is when your passive income is able to cater to your lifestyle, whichever way you want it to be. And financial independence is where it's going to cater to your current lifestyle. I'll give you an example. Say you have a job, you have the salary, you can make up a decision of, say, going to Goa for the weekend, and you can fly immediately. You can go to Goa, stay in the best place. Your work demands you to come back. But I guess in financial freedom, it is more that, you can go to Goa and you can choose to have a life there. So that is where your financial freedom just says that I am able to cater to any lifestyle of my choice at the end of the day, versus in financial independence, where it is very catered to the fact that this is my current life. It pays off everything in a beautiful way. And the same picture goes on next month, the month after, and the month later. So financial freedom is a net instrument of every financial independence, investments that you have made, something that speaks for itself. It even backfires the whole 4% at the end of the day, because a 4%, if you can make it 50%, 100%, you never have to look back. Versus a financial security, which kind of gives you that, okay, fine, this is the income that provides me for my basic necessities at the end of the day. But in financial freedom, you don't have to worry about the solvency part of it. You don't have to worry about, you can always take in more. So that is like the last step of after financial independence, which is more like the nirvana stage.
Okay, thank you, ma'am.
Thank you, Malvika. Yes, Afro, tell me. Thank you for the question as well. Personally, I don't have any credit cards because, like you said, I think I was a conservative investor. But credit cards today actually is a good thing. 2 reasons. One is, like you mentioned, CIBIL ratings, right? So this is something that today, considering that, there could be an influx of income that we are not able to accumulate, but we have a very good investment plan, or very good thing that, is needed for me to have a credit into. And if you can vouch that you will pay it off on the determined timelines, yes, credit cards are a good option. We can go forward, and you can always keep a benchmark of what an expenditure should be. So you can have a credit card with just, say, 40,000 rupees of, a removal from the bank, or you can have a credit card for up to 1 lakh. All you need to make sure is that yes, that has to be budgeted very well. It will definitely help you if you can do it in a way where you're paying off right on time, you're investing in the right properties and instruments, because your CIBIL rating will go up, which eventually will come to a point where tomorrow the players in the market will be like, hey, Afro, you have a very good credit rating, so we will definitely make sure that you can get any kind of a loan in the future. So 5 years down the line, you want to set up say a store of yourself, or you want to buy something for yourself. This CIBIL rating will definitely help you in the future as well. Being thoughtful about it is what it is, what you will have to take, and making sure that the threshold of how much to withdraw you can keep in mind as well, and always understand that to various banks, right? So you have nationalized banks and versus private banks, right? So understanding what is the interest rate that they are charging you as well, and what are the kind of loans that they can provide you, how often can you pay back those loans on the credit card as well, is important. So if you're again a person who's a spendthrift and gets very impulsive, I wouldn't suggest it. But credit card overall is a good choice. Okay. Do we have questions in the chat box? How good is crypto as an investment? Okay. So the last instrument I was working before I quit Goldman Sachs was blockchain trading. But again, unfortunately, it's been over the years, it is still a decentralized instrument. So the risk in that is insane. There is no refund promised. So this is a highly yielding instrument which has crazy high risk attached to it as well at the end of the day. So I was actually taking down some points, because when something is unregulated by any market, for instance, right? Like for instance, when you say you take a life insurance and then you get to know that the third party is not going to cover for you and you have no refund for the premiums you have paid, that is a major loss at the end of the day. So crypto investments, unless you are very sure that it is going to repay you or it is going to be a short-term investment, I wouldn't personally suggest it, because it is still volatile and it is still not centralized by any agencies. There is no backing up on it. So it is true that 3 years and from 2018, it made a crazy boom in the market by the anonymous creator himself, Satoshi. So again, this is something that today's generation should learn a lot about. Like just maybe say how whoever started commercial papers or mutual funds whenever they came up with the plan or whenever they made up the idea. But cryptocurrencies today, that kind of a technology, if you think that you are a high risk taker, at the end of the day, it doesn't really, the yield doesn't really matter to you, yes. But it's still being highly volatile and being decentralized. I personally don't feel that I would invest in it yet. Does that answer your question, Rohit? Thank you. Great. I will give it a couple of more minutes. Great. If no other further questions, thank you so much for having me today. And I really hope I have explained everything to the best of my abilities. Feel free to get in touch with me on LinkedIn as well. I hope to continue this relationship with you guys.
Thank you so much, ma'am, for this wonderful session. Hope everybody has find it informative and interesting. Now, I guess everyone can leave the meeting. Thank you so much, ma'am.
Thank you. Thank you, team. Bye.